Thank you for the introduction and inviting me to speak today. I've been following your work from the beginning of my journey into investing. So let me start with a brief introduction to Hosking Partners. So the firm, the history dates back to 1986 when Jeremy Hosking developed the capital cycle framework alongside his two other co-founders of Marathon Asset Management. And he'd really gone through a difficult period of managing a technology fund in the 80s, whilst there was a big PC boom. And he was really asking himself, how do three people sitting in London without an army of analysts and a small amount of AUM tackle this global opportunity set? And that's where he really came to this idea of focusing on the supply side of industries rather than thinking about demand. And that was the basis of the capital cycle. Hosking Partners was set up in 2013. It essentially was the global team from Marathon that left to build a firm focused on long-term contrarian investing with a single product, but an unusual structure where we have five portfolio managers managing a sleeve of the capital. And these are the two books that form the basis of the capital cycle framework. Many of you will be familiar with them. They really walk you through the application of the framework during two very distinct periods. So one being the technology bubble in 2000, and then capital returns a few years after the GFC. And this framework is the kind of the philosophical bedrock of everything that we do at Housing Partners. So coming to Japan, our interest really began in 2022. Since inception of the fund, we'd owned very little Japan, but we were beginning to observe this behavioral change from Japanese management teams in a few companies that we had known for a long time. And that really intrigued us, and we began to dig in. And really, until then, as many of you will know, the valuations of Japanese companies had been held back for decades by practices designed to maintain stability in the wake of the asset bubble popping in the 90s. The management teams that prioritize high employee retention, cash accumulation, and really in the absence of investing for growth and shareholder returns. But this really began to change with the introduction of Abenomics in 2012, which ushered in this era of structural reforms, shareholder engagement, and this real focus on corporate value. This was reinforced by various government policy initiatives, so the Stewardship Code in 2013, the Corporate Governance Code in 2015, and various guideline updates by METI on rules around M&A takeovers. And this really began to change the attitude towards shareholders. And when we looked at the data for the previous decade, whether it was the falling share of cross holdings held by companies in Japan, the proportion of outside directors on boards, the number of shareholder proposals by activist funds, and shareholder returns sitting at all-time highs, it was clear that change was already underway for a number of years before this moment. And then really, and whilst this was going on, still more than half of corporate Japan was trading below one times price to book. And so all of this really culminated with a letter sent by the TSE to the whole of corporate Japan, essentially requesting for them to lay out a plan to improve returns on capital if they traded below one times price to book. But how does this all fit into the capital cycle framework? And for me, from the two books, this is one of the most important quotes. Over the long run, it's a company's return on capital, not changes in quarterly earnings, which primarily drive the direction of share prices. By shifting your focus away from the noise around short-term earnings, which I think most of the industry spends their time on, to thinking about where the return on capital for a company, sector, or country could be in 5 or 10 years' time, you have a much better chance of predicting where long-term share prices are going to be. And there are really two ways to improve return on capital. The first one, the obvious one, which is improve earnings. And I think that's how most people think about this equation. But I think the more underappreciated but equally powerful way is to shrink the capital base, so the denominator in this equation. And in Japan, at an aggregate, earnings growth hadn't actually been the issue. If you looked from 2015 to 2022, earnings had compounded about 6% per annum, and the only country to exceed that over the same period was the US. But the issue was the ever-growing bloat in the capital base across the majority of corporate Japan. And so we really believe that Japan had the potential to be a capital cycle at a country level. And for the last 3 years, we have been investing in a series of deep value opportunities, primarily in the small and mid cap space. Um, but those opportunities are not for everyone, and not everyone can exploit them. So today I really wanted to talk about a holding in Japan. It's our largest, and it's a company that I think could have broad appeal to the audience, and that's Hikari Tushin. And who themselves are actually exploiting this reform opportunity in Japan, but we'll come to that later. And we often find this when you're turning the pages in an out of favor sector or country, you occasionally come across an outlier, whether it's a unique business model or an exceptional management team. We first invested in Hikari in late 22, and over the last 3 years, we've had engagement across multiple levels of the organization to learn more. And it's really a company that's been operating under the radar in Japan with a very unique culture, with this obsession over capital efficiency, which again is very different to the majority of corporate Japan. And so far, it has resulted in this very impressive track record. Over the last 15 years, they have compounded operating profits above 20%. They've compounded book value at 17%, the dividends that they pay shareholders at 17% also. And all of this has been done whilst maintaining an ROE above 16% and shrinking the share count by 18%. And so how have they achieved this? It's helpful to go through the history of this company to understand it better. And it's a really long history and a fascinating one. Someone should really write a book on what's happened at this company for the last 3 decades. But I'll try and condense it down to the key events. And it starts with a young Yoshimitsu Shigeta, age 23. He drops out of university to found Hikari as a door-to-door sales operation, selling office equipment such as copiers, fax machines, and telephones. And in the mid 90s, he enters the mobile phone market by opening retail stores. And he really rides this big boom in mobile devices in Japan in the 90s, becoming a key distributor for the major telcos like NTT, Docomo, and SoftBank. And the retail network that he develops, which was called the Hit Shop, reached 1,800 stores nationwide and was recognized as the nationwide brand for mobile phone retail. And at the height of the bubble in early 2000, the market cap of this company was 50 to 60 billion dollars. The shares traded at over 700 times earnings, and he became one of the richest people in the world. And as you can imagine, this was followed by a share price decline of 99%. The sales contracted, they had expanded far too aggressively. They discovered fraudulent activities by various of their sales staff at the store level. They had made a bunch of venture investments that had to be written off. They had taken on too much debt, and they needed to raise equity. But Shigeta, through his courageous efforts, saved the company from bankruptcy by injecting more capital, cutting the cost base, and laying off people. And it's really around this time that he starts to look for a better way to run a company. And according to the employees that we've spoken to, It's at this point he comes across Warren Buffett. He visits Omaha in 2002, and he begins to study many of the great capital allocators in the US, so such as 3G, Roper, Danaher. In fact, Hikari at this time buys a stake in Berkshire, which they still own to this day. Um, and they spend the next few years stabilizing the business and returning it back to profitability. But then in 2010, they make this pivot toward in-house products. These are products and services developed by Hikari rather than being a complete, just a pure reseller of other people's products in order to create a more resilient business model with a greater share of recurring revenues. And led by Shingeta, the entire firm becomes obsessed about directing capital to the highest areas of return, whether that's in your core business or investing it in public stocks, which they do later on. And the business also goes through a leadership transition where Shingeta moves to chairman, and Wada-san, the current president, who also joined the firm as a college graduate, works his way up the firm purely based on merit and how well he did in various different roles. So the best way to really describe the company today is a holding company with three arms: the business, the core business, the public investment portfolio, and their ability over time to acquire assets outright. Now, this will has drawn comparisons to Berkshire. However, I think there are some significant differences. Because as opposed to collecting a diversified portfolio of assets in different industries, Hikari's core business and its acquisitions over time have remained very focused, and they've really built on the existing strengths of being one of the best sellers and distributors of essential services and products in Japan. So the left side of this slide illustrates this transition that I talked about in the history from selling office equipment and mobile phones to higher margin self-branded products such as water services for offices, mobile and home appliance insurance, and becoming an independent provider of electricity. And the real lesson from the collapse in 2000 was that by selling other people's products, you were really at the whim of the producer. It resulted in these highly volatile commission revenues, and you also bared the risk of the significant operating leverage of having this very big sales force on your P&L. So at the same time as developing these in-house products, which they started to do in 2009, 10, they shifted the major fixed cost base on their profit and loss statement to these agency partners. So, for example, they no longer own any of the mobile phone stores. They franchise those all out to some of these agency partners. And in the new model, they pay the one-off commission to the agencies for a sale. But the customer, the end customer, pays Hikari the annual payments for the service. So Hikari gets to own the customer relationship. The main product areas today are electricity and gas provision, telecommunication lines, office water delivery, and insurance, mainly in smartphone insurance and home appliances. And today, 80% of the revenues are more reoccurring in nature. 20% are still the more commission-like revenues. And they estimate that their churn level at the group level is less than 2%. So at first glance, you could still perceive this to be a fairly low quality business selling commodity services. But I really think that the advantages that Hikari have built upon over the decades are really underappreciated. The first is